Welcome to Bellwether Wealth's webinar series, Navigate Exit Planning with Confidence. In Season 1, Drive Your Business Like You're Going to Sell It, we're joined by John Fulwider, a business value growth advisor at Gear 80. For today's episode, we will learn why predictable, sustainable revenue growth matters.
All right, let's get this going. Business owners, man, they can't get out of day-to-day management, and 80% of them can't sell their businesses. The free 14-part webinar series you're in today shows you how you can free yourself from day-to-day management and double the value of your business. That way, you can successfully sell it when you want, to whom you want, at the price you want, or decide to keep it as a highly profitable asset. All you have to do is drive your business like you're going to sell it. That involves focusing your work on the three dimensions of business growth. One, creating predictable profit and cash flow growth. We covered that in part one. Two, creating predictable, sustainable revenue growth. That's what we're focusing on here in part two of the webinar series. Three, creating predictable, transferable value. Now, there's a great side effect of focusing on these three dimensions, which is that your business gets easier and more fun to run. Like I've been saying, there's 4 parts to this webinar series. Today, we're starting part 2, creating predictable and sustainable revenue growth. Part 1 was the launch pad for growth, predictable profit and cash flow. We've got recordings of those episodes if you missed them, and we're posting that link in the chat. Today, we're going to focus on why predictable and sustainable revenue growth matter. Then on November 13th and 20th, we'll cover parts 1 and 2 of how to grow revenue predictably and sustainably. The webinar series continues most Wednesdays through the end of January. To see the complete schedule, visit Bellwether Wealth's exit planning page. We'll post that link in the chat as well. So, 3 reasons why predictable and sustainable revenue growth matter. 1, because buyers want to see revenue growing steadily up and to the right. 2, because roller coasters are only fun at amusement parks. And 3, revenue growth is the #1 goal of business owners, and you can have it when you PE yourself. I'm John Fulwider, and I'm your guide for this webinar series. I've helped more than 40 business owners grow their profit, revenue, and the value of their business, all while making it easier and more fun to run. My clients have succeeded with many of the major types of business transitions, to strategic buyers, to private equity, to the company's management, and to the next generation of family members. And I'm proud to say many of my clients have earned a spot on the Inc. 5000 list of fastest growing American businesses multiple years in a row. Finally, I'm a certified exit planning advisor, which just means I've got special training on collaborating with other professionals like financial advisors, exit planners, accountants, and attorneys to help business owners successfully reach their finish line. This webinar series is for business owners who are experts in running their businesses, but not experts in selling them. Most business owners sell their business only once, so for them, it's a high-stakes, complicated project. Throughout the series, we're focusing on 2 types of business owners, Got-type Greta and Want-out William. Got-time Greta has a successful business generating a nice income for her. She's thinking, I don't want to go anywhere tomorrow, but I'm not sure I want to be required to be here 3 to 5 years from now. Want-out William, on the other hand, is tired. He doesn't have another Great Recession and global pandemic in him. He wants out in a year or less. This series revolves around a free assessment that gives you a rough estimate of what your business could sell for today. When you take it, you'll also learn how much more you could sell your business for after you increase its profit, revenue, and value. This can be as much as double of what you could sell your business for today. You've got to know where you are to plot a course to where you want to be. So scan this QR code with your phone to load up the assessment now, or click on the link that we're posting in the chat. On to the reasons predictable, sustainable revenue growth matter. This is a webinar series about exit planning, so we'll put buyers first. Buyers of companies like yours like to see revenue moving up and to the right. They like it because it reduces risk. Buyers are buying an asset they expect a return from. When they look at steady results from the last 3 to 5 years, it gives them confidence in the next 3 to 5 years under their ownership. Along the same lines, solid past revenue performance makes for easier due diligence. That's that process I've compared earlier to a confrontational colonoscopy, where buyers go through your business with a fine-toothed comb looking for the good, the bad, and the ugly. And they want to see evidence that your business isn't riding a temporary wave, but instead that you've mastered the art of sustainable revenue success. I had such a temporary wave in my own business, and it was a one-shot thing. 25% higher revenue than usual that year. My financial advisor still talks about it. Hey, John, remember that one year? Yes, Blake, I remember it fondly. But seriously, big ups and downs don't look good to purchasers. It's kind of like when employers look at big gaps in people's resumes. They want to see steady upward growth, not a bunch of stops and starts. Finally, a record of past performance helps buyers plan for growth. Buyers are planning to grow your revenue more, so they want to see it's grown before. The second reason predictable and sustainable revenue growth matter is that roller coasters are only fun at amusement parks. For most business owners, growth is their number one goal. That's what owners in general want. Here's how owners I've worked with feel. Your business is successful. You're moving fast, up and to the right, and it's not a smooth ride. The car is shaking so much, it's rattling your teeth. The road's not smooth, and you're driving up mountain switchbacks with 1,000-foot drop just a few inches past your tires. And you wish you could replace the engine with a faster one, resurface the road, and install guardrails, all at the same time. Point one, you want to grow revenue without flying off the road. Point two, reliance on one revenue producer stinks for the producer and for the business. I talked recently to the owner of a professional services firm. It's a big one, and he's still the rainmaker. He told me he feels like he's constantly running at 7,000 or 8,000 RPM when he'd prefer 5,000 or 6,000. He's burning out. He's got the weight of the world on his shoulders. And worse, he's got a business that's in danger of not being sellable. Because buyers want a business that can thrive without the owner. Ideally, in fact, it would already be thriving without the owner, that is. So, point three, a business owner's day is the highest highs and the lowest lows. So why add quarterly, annual ups and downs in revenue to the business owner's crazy roller coaster of a day? Something that holds companies back is looking inward and asking, what should we do to grow revenue? Instead of looking outward and asking, what are the best companies doing to grow revenue? So here's what I'm advocating. We should look outward at what best-in-class competitors are doing to grow. And we can do that while preserving our secret sauce, our individuality, our creativity. In fact, increasing our individuality and creativity and making our special sauce even more special. Because now that we're following best practices that we've gotten from the outside on the basic blocking and tackling of business growth, we have more time and energy to devote to what makes us uniquely different and valuable in the marketplace to our target customers. Maybe the most famous story of looking outward happened at Intel in a conversation between Andy Grove, who was then Chief Operating Officer, and Gordon Moore, who was CEO. Yes, that Gordon Moore, the one who has a law of technology named after him. Andy Grove asked Gordon Moore, if we got kicked out and the board brought a new CEO, what do you think he would do? Moore immediately replied, he would get us out of memories. Grove then proposed, why shouldn't you and I walk out the door, come back in, and do it ourselves? And they did. and Intel became a powerhouse in microprocessor manufacturing. The last reason predictable, sustainable revenue growth matters is because it's something you can achieve when you PE yourself. Doing so means looking out at what best-in-class businesses are doing. A lot of these best-in-class businesses are owned by private equity firms. With the growth playbooks that you're getting from this webinar series, you can run a self-directed private equity play. That is, you can more aggressively grow your company like a PE firm would, while still protecting your non-financial values, like taking care of your loyal employees and keeping your operations in your community. You can enjoy the increased profit, cash flow, and revenue that will result, all while the business gets easier and more fun to run. And you can then sell for a nicer payday or keep your company as a high cash flowing asset. So I've been briefly talking about this PE yourself approach in previous episodes of this webinar series, and today I'm going to take the deepest dive. Before we do that, I just want to acknowledge that there are fans and there are foes of private equity. So let me introduce you to both groups. Recent positive books about private equity include Private Equity Deals, Lessons in Investing, Deal-Making, and Operations from Private Equity Professionals by Ted Seides, and the Private Equity Playbook, Management's Guide to Working with Private Equity by Adam Coffey. Recent negative books about private equity include Plunder, Private Equity's Plan to Pillage America by Brendan Ballou, and These Are the Plunderers, How Private Equity Runs and Wrecks America by Gretchen Morgensen and Joshua Rosner. I'm now going to give you a preview of part 4 of our webinar series, Exit Options. One of them is selling to private equity. When you sell to private equity, you will have to add debt to your balance sheet, which the business must pay back. Report to a board, aka answer to investors, triple revenue in 3 to 7 years through organic growth and mergers and acquisitions, expand into new markets or product lines, rebrand or reposition the business. Now, I want to be balanced here. I just said that you have to do these things. Another completely legitimate way of looking at this list is that you get to do these things. On with the list. You also have to, or get to, improve operational efficiency and margins, rigorously follow a sophisticated budget. The bottom line in all this means professionalizing the business. Another bottom line is it means you get to participate in the upside. When private equity acquires you, you can roll some of the proceeds from selling back into the company you just sold and get a nice return when it's sold again in 3 to 7 years. For more on that, see the Private Equity Playbook by Adam Coffey. We're posting a link to that book in the chat. Or you can PE yourself. This requires a shift in mindset on your part from owner-operator to owner-investor. When you've made the shift to expecting investment-grade performance from your business, you're on the way to successfully PEing yourself. Here's more on what looking out at what the best are doing instead of looking inward. These are some examples of what private equity owners do when they expect investment-grade performance from your business. Private equity firm KKR bought CHI Overhead Doors in 2015 and then sold it 7 years later for a price more than 4 times higher than it paid. CHI manufactures custom garage doors. Here's what KKR did over those 7 years to increase CHI's value. I'm going to read it fast so you get the feel of how much KKR did to increase the value of this company. Here we go. Increased manufacturing worker engagement to decrease turnover, created a sales growth plan, improved shop floor productivity, reduced inventory, created a head of procurement function, captured price deflation in the steel market, restructured sales leadership so all the salespeople weren't reporting to just one person. By the way, how many of our companies are guilty of that? Brought in health and safety help to reduce a high injury rate, reduced scrap and rework, drawing a breath, and there's more. Brought in operational help, brought in strategic marketing help, brought in a culture change consultant, and then we went on an operational improvement journey, and then we did a lot of Kaizen. Whew. All of this is according to an interview with Pete Stavros, KKR's head of private equity. You can listen to or read the whole thing in the book Private Equity Deals by Ted Seides. We're posting a link to that book in the chat. I'll wrap up today's discussion of private equity with another preview of part 4 of the webinar series, where we'll talk about selling to private equity as one of your exit options. A few quotations from the book I just mentioned, Private Equity Deals, reinforce what we've been learning in this webinar series about how to make your business sellable to any buyer. Quoting from the book, an ideal private equity acquisition target, and I would say an ideal acquisition target for any type of buyer, is a high quality business with great management that can operate efficiently with debt on its balance sheet. That part about debt on its balance sheet, that is more on the private equity side, but can also be true in other types of transactions. Moving on with the quote. Some of these business characteristics include the following: free cash flow generation. Where have we heard about that before? Consistent, steadily growing revenue. We've just heard about that. Insensitivity to economic cycles, pricing power, diverse customer base, efficient cost structure or low-hanging fruit to reduce cost, and outstanding management or readily available new management team. I hope you're seeing the connections here with what we've been learning. Free cash flow generation is predictable profit and cash flow from part 1 of the series. Consistent, steadily growing revenue is the predictable, sustainable revenue growth we're talking about here in part 2 of the webinar series. And outstanding management is the effective senior leadership team objective we talked about in part 1. So in conclusion, great businesses are coveted by private equity firms. So why not make your business great and then maybe sell? This is a theme I've been pushing since the beginning of our webinar series here together. Making your business better makes it sellable. Making it sellable makes it more desirable for you to keep, or more desirable for others to buy. The argument I'm making here is that creating an excellent company, a company that's capable of anything, has already been figured out. Now it's up to you to determine how to use those capabilities to best serve the customers that you care about most. And that's it for today. Our series continues next week with part 1 of how to grow revenue predictably and sustainably. Then we'll cover how, part 2, the following week. With that, it's time for Q&A. Remember to type your questions in the Q&A section of your Zoom window, and someone on the Bellwether Wealth team will then read each question aloud, and I will then answer them. So what questions do you have?
Okay, John, what kind of growth rate should I be going for?
Good question. My colleague Steve Prada argues that, and here I'm reading from a book of his that I'll mention. He argues that on a 5-year time horizon, an ordinary private business can feasibly grow its revenue by 2.5 times, by growing 20% a year. He goes on to say, such growth necessitates and forces internal process improvements and external differentiation, which can then double net profit margin. So here we're talking not just about revenue growth, but also about profit growth. And that will result in a 5x or higher growth in the value of the business. So what I want you to hear in that quote from the book Pinnacle by Greg Cleary and Steve Prada is, in one paragraph, all three dimensions of business growth are present: predictable profit and cash flow, predictable sustainable revenue growth, and predictable transferable value. So you want to be going for all three. 20% annual growth is completely reasonable. Now, some of my clients have done far better, as we've introduced the webinar in each episode. I've shown the clients of mine who have been on the Inc. 5000 list multiple years in a row. And they've done that because they're among the 5,000 fastest growing companies in America at that time. So what kind of growth did they achieve? Data Vision, a managed services company, 83%. Barry Law Firm, a law firm, 99%. Bulu Group, a marketing and logistics firm, 102%. Summit Lawns, Lincoln and soon to be Nebraska's leading lawn care company, 165%. CFO Systems, an outsourced fractional CFO firm, 211%. Summit Contracting, the region's leading builder on the farm for farmers, 236%. And Company Cam, a software company for contracting firms, 246%. Keep in mind, though, I'll wrap up my long answer to a short question with this. Keep in mind the argument that the book Small Giants makes. Small Giants is a book that has a subtitle that talks about the kind of companies that this appeals to. It's companies that choose to be great instead of big. And that book has a couple of quotes that I really like as we think about what kind of growth do we want. And the book says, greatness is about who you are and what you stand for, not about the amount of money you make. And it goes on to say, the best companies are not focused on being the biggest, they are focused on being the best. All right, what else have we got, Kim?
The question is, I would like to hear more about alternatives to PE. Will we be covering those?
Yes, we will be covering all the alternatives to being purchased by private equity. I imagine that's what you're talking about. We'll talk about selling to family members. We'll talk about selling to management. We'll talk about selling to a strategic acquirer, a financial acquirer. We'll talk about employee stock option programs where you sell to the employees, and yet more. There's a lot of options, and we will cover all of them. If you are getting close-ish to a transaction and you just want somebody who's a good listener and, semi-well informed about the options, man, email me, set up a call. I'd be happy to help. John@gear80.co, and then my phone number, 402-202-2820. Kim, would you mind throwing those in the chat? Actually, I can do it. Nope, looks like I can't. You're going to have to. Okay. After you do that, next question.
So they wrote, professionalize sounds like corporate. I don't want my business to go corporate.
Yeah. I get it, right? It's a fair way to look at it. Look, we business owners, we got into business for freedom. We got into business so we don't have to work for the man or the woman anymore. So, and some people left corporate careers to start their businesses, and they don't want to go back to the bureaucracy and the politics and the drama and the endless meetings and the expense accounts. I get it. And to sell your business successfully, you're gonna have to make your business run on systems, not on the force of your personality and the knowledge that's locked up only in your head. I think it's entirely possible to create a business that's professionally run and still feels creative and exciting. In fact, I would argue, as I think I did earlier in our time together this morning, that when you put the basic blocking and tackling of business, the stuff that's already been figured out, when you put it on autopilot through professionalized systems, sure, I argue that you free up your energy and creativity, and you can use those to push back the corporate and make your business more creative and exciting. Great question. What else we got?
Well, I'm wondering, I don't see any other questions coming in.
All right. Well, no worries. Nobody ever complained about a meeting that ended early. So let me just wrap us up and get us back to our days here. So you can free yourself from day-to-day management and you can double the value of your business if you'll focus your work on the 3 dimensions of business growth. 1, creating predictable profit and cash flow growth. 2, creating predictable, sustainable revenue growth. And 3, creating predictable transferable value. And when you do that, you'll be able to successfully sell your business when you want, to whom you want, at the price you want, or decide to keep it as a highly profitable asset. All you have to do is drive your business like you're going to sell it. I'm John Fulwider, and I'm looking very forward to seeing you next week for How to Grow Revenue Predictably and Sustainably, Part 1.